Okay, let's unpack this. Welcome to the deep dive. This is the show where we take, well, a whole stack of information, research, guides, you name it, and we try to boil it down into something really actionable, something insightful for you. And today, we are plunging headfirst into a topic that gets talked about a lot, definitely dreamed about a lot, but maybe its true financial power is often underestimated. We're talking about home ownership.
Yeah, beyond just, building equity, owning a home can unlock this surprising range of tax benefits, benefits that work directly in your financial favor, especially when tax season inevitably rolls around. For so many people, the idea of buying a home brings up images of these huge financial commitments, right? Big down payments, those ongoing mortgage payments, and of course, property taxes that can sometimes feel like this relentless burden. And look, those are all very real parts of owning a home, no doubt about it. But what if we told you that the tax system, the thing often seen as this confusing maze designed to take your money, is actually set up to actively encourage and, yes, reward homeownership? So our mission today.
Cut through that perceived complexity. We've digested a really comprehensive guide focused specifically on home ownership's tax advantages, plus some supporting research to distill the absolute key nuggets of knowledge for you. Our goal is simple: give you a real shortcut to being well informed. We want to uncover those valuable deductions and credits you might not even know exist, and ultimately, help you understand how your home can become this strategic asset, something that really impacts your financial security.
It really is fascinating, isn't it? What's truly fascinating here is just how often these, significant financial advantages get overlooked or maybe just misunderstood. This happens with current homeowners and definitely with people thinking about buying. Understandably, many people focus on the upfront costs, the monthly payments, the responsibilities, and the tax law stuff. It feels complicated, so they kind of shy away from exploring those financial upsides. But as you're going to hear in this deep dive, getting a handle on these specifics, it can genuinely shift your whole perspective. Homeownership moves from being just, a big expense or simply a place to live to becoming a highly strategic, really powerful financial asset. It's that aha moment just waiting for so many people when they realize the tax efficiencies that are actually built into the system for them.
That's a perfect way to frame it. So let's zoom out for just a second. Let's look at the big picture first. Home ownership as a truly strategic financial move. I mean, for most people, individuals, families, buying a home isn't just about getting a place to live. It is typically the single largest investment they will ever make. Full stop. But like you said, it's more than just building equity slowly over time as you pay down the mortgage or, crossing your fingers for market appreciation. Home ownership really acts as this powerful cornerstone for a solid long-term financial strategy, especially when you factor in these tax implications we're about to really dig into. Think of it almost like a complex financial puzzle. You see the pieces, right? Your income, your expenses, your saving goals. But when you strategically place that homeownership piece and leverage it correctly within that bigger puzzle, it suddenly illuminates a much clearer, much more robust picture of your financial future. It's really about building tangible wealth, getting that stability, and crucially, using the tax code to your advantage, not just, having a roof over your head.
Exactly. And if we connect this to the bigger picture, what our sources really emphasize is that homeownership isn't just about shelter. It's fundamentally about leveraging a set of deliberate government incentives. These incentives are designed specifically to encourage citizens, people like you, to grow personal wealth and achieve that long-term financial stability. The tax code, it's quite intentionally structured to promote homeownership through all these different deductions and credits we'll cover. This isn't some accident. Governments often see high rates of homeownership as good for society. Think community stability, local economic growth, people feeling more invested in their area. So for homeowners who are savvy about this, who understand and actually use these provisions, it means they can effectively lower their overall taxable income, reduce their direct tax liabilities. Their tax burden gets lighter year after year. And this isn't just about saving, a few bucks at tax time. It's about optimizing your entire financial landscape for potentially decades. Having this comprehensive understanding can really influence big decisions around major life events. For example, the money you save from taxes. That could be reinvested. Maybe it goes into other assets. Maybe it helps fund a child's education. Or it could directly beef up your retirement savings. it transforms homeownership. It becomes this dynamic part of your financial portfolio, offering advantages you often just don't find in other types of investments.
That sets us up perfectly because now we're going to dive right into the core of it all. The 7 key federal tax advantages of homeownership. These are the specific ways the tax system can put real money back in your pocket. We're going to break down each one, explain not just what it is, but why it matters to your wallet, and importantly, how you can best use it. Okay, first up, the absolute heavy hitter, the big one. This impacts most homeowners in a really significant way. The mortgage interest deduction. This is consistently one of the most substantial tax benefits out there, and for very good reason. So the basics. If you itemize your deductions on your federal tax return, and that's a key point, you have to itemize, you can deduct the interest you paid on your mortgage. Now, the specifics here are crucial. This deduction generally applies to the interest paid on mortgage debt up to $750,000. That's the current limit. However, there's a grandfather clause. If you happen to purchase your home before December 15, 2017, that limit is actually higher. It's $1 million. Yeah, and what makes this deduction particularly compelling, really interesting, is its impact, especially in the early years of your mortgage. Think about how a typical mortgage works, right? It's amortized. So in those initial years, a much, much larger chunk of your monthly payment goes towards paying interest, not paying down the actual principal balance. What does that mean for you? Well, if you've just bought a home, you're likely making pretty significant interest payments. And that translates directly into a larger deduction right when your other homeownership costs are also probably at their highest. Let's take an example. Say a $500,000 mortgage, maybe at 6% interest. You could easily pay over $29,000 in interest in that very first year, just interest. Now, if you can deduct even a good portion of that because you itemized, you could be looking at thousands of dollars in actual tax savings. So this front-loaded interest provides this kind of compounding tax relief. It can make those crucial, sometimes tough early years of owning a home just a bit more manageable. It really shows how the tax system is set up to support homeowners right from the start of their biggest financial commitment.
And there's a very clear policy reason behind this deduction. It's a deliberate government incentive designed fair and square to encourage investment in real estate. The government recognizes those broader benefits societal economic that come from widespread homeownership, things like community stability, local economic activity. To make it more tangible, let's run those numbers slightly differently. Imagine you're a homeowner. You paid $18,000 in mortgage interest this year. Let's say you fall into the 24% federal income tax bracket. Okay, if you itemize, and you can deduct that full $18,000. That directly reduces your taxable income by $18,000. What does that mean in actual cash? Well, 24% of $18,000 is $4,320. That's a $4,320 saving on your federal tax bill, actual money that stays in your pocket. It effectively lowers the real cost of borrowing for your home. And that in turn can make homeownership more financially accessible, more sustainable for more people, which feeds back into that long-term wealth building strategy we talked about. Oh, and importantly, your mortgage lender will send you a form each year, Form 1098. It details exactly how much mortgage interest you paid.
So claiming this deduction, if you itemize, is relatively straightforward.
Right, that Form 1098 is key. Okay, so that's the big one, mortgage interest. Massive. But there's definitely more. Let's talk about the property tax deduction. Ugh, property taxes. Nobody loves paying property taxes, do they? It's often one of the higher ongoing costs of owning a home. And sometimes it just feels like this never-ending bill from your town or county, especially if you live in certain higher tax areas. But here's some good news. There's an offset, a way to soften that blow a bit on the federal side. Homeowners can deduct their state and local property taxes, up to a combined maximum of $10,000 per household per year. This includes property taxes and potentially state and local income or sales taxes too, but the total SALT deduction is capped at $10. So this deduction, again, only if you itemize, directly helps offset those local burdens. It makes your overall federal tax burden lighter. It's a really crucial offset. It makes a real difference, especially, like I said, in areas with higher property taxes where hitting that $10,000 cap might happen just with property taxes alone. It alleviates some of that local financial pressure.
Indeed. And if we connect this to the broader context, that $10,000 limit you mentioned, the state and local tax or solid cap, that's a really important piece of this conversation. This cap was a pretty significant change. It was introduced by the Tax Cuts and Jobs Act back in 2017. Before that law, there generally wasn't a cap on how much state and local tax, including property tax, you could deduct. Now, obviously, that $10,000 limit, it was and still is a point of contention, especially for homeowners in high-tax states. Think New York, California, or as we'll discuss later, Illinois. But even with the cap, it still offers substantial relief for many, many homeowners across the country. For example, maybe pay $8,000 in property taxes and another $3,000 in state income tax. Without the cap, you could deduct $11,000. With the cap, you still get to deduct $10,000. So for a huge number of homeowners, especially those in states with more moderate property tax rates, that $10,000 deduction, it can still represent a very significant chunk of their annual property tax bill, directly reducing their federal taxable income. It's a tangible way the federal system lets you recapture some of those local tax payments.
Shows that even with limits, there's still a mechanism to soften the blow.
Okay, got it. Now, let's shift gears a bit. For those of us whose homes have also become our workplaces, and that's a lot more people these days, there's the home office deduction. This one's become super relevant, right? With the rise of remote work, flexible schedules, so many people are working from home now. So here's the deal. If you use a portion of your home exclusively and regularly for your business or work, you might qualify for this deduction. Now, those words exclusively and regularly, they're critical. The IRS is pretty strict here. So what does that actually mean for you if you're, say, working from your living room corner? Well, if you qualify, it allows you to deduct a portion of your home expenses. We're talking things like utilities, your internet bill, home insurance premiums, maybe some maintenance costs, even depreciation related to your home, all as they pertain to that dedicated work area. And get this, it's not just for self-employed people or freelancers. If you're an employee working remotely, maybe because your employer requires it or for their convenience, and you meet those strict IRS criteria, this deduction could apply to you too. It's a smart way to account for the real costs of using your personal space as a professional one.
It is appealing, definitely. But like you said, those strict IRS criteria, understanding them is absolutely crucial to avoid any problems down the line. That exclusive and regular use rule is really paramount. Exclusive means the space only gets used for business, not for personal stuff, not for hobbies, nothing else. And regular means you use it consistently for business, not just occasionally. So for instance, your kitchen table. Probably not going to qualify if you also eat meals there or the kids do homework there. But a dedicated spare bedroom set up as an office, or maybe a specific room you converted into a studio, or even a clearly defined section of a larger room or basement used only for business. Those could be eligible. Now, when it comes to actually calculating the deduction, you generally have two main options, the simplified method and the regular method. The simplified option is, well, simpler. You deduct the standard amount per square foot of your home office, up to a maximum square footage. I think the rate recently has been $5 per square foot, capped at 300 square feet. So max deduction of $1,500 using that method. The regular method, it's more complex, requires more record keeping, but allows you to calculate your actual expenses based on the percentage of your home used for business. So if your home office is, say, 10% of your home's total square footage, you could potentially deduct 10% of your qualifying expenses like utilities, insurance, repairs to that area, depreciation, etc. If your actual expenses are significant, the regular method often results in a larger deduction. But, and this is key, regardless of which method you choose, you must maintain meticulous records. Think floor plans showing the dedicated space, receipts for any direct expenses like painting just the office, allocated utility bills, everything. You need proof to justify your claim and avoid those common mistakes that might, raise a red flag with the IRS.
Records, records, records. Got it. Okay, let's talk about something that feels like a real win-win scenario. Energy-efficient home improvements. I mean, most of us want to save on our utility bills, right? And maybe do our part for the environment, too. Well, the federal government offers some pretty significant tax credits for specific energy-efficient upgrades you make to your home. And notice I said credits. These aren't just deductions, which lower your taxable income. Credits are even better. They directly reduce your tax bill dollar for dollar. So what kind of things are we talking about? Investments like installing solar panels, upgrading to energy-efficient windows or skylights, adding certain types of insulation, specific exterior doors, even qualifying high-efficiency HVAC systems like heat pumps. These are investments that don't just save you money on your taxes in the year you make them, they also lead to potentially significant long-term savings on your energy bills month after month. Plus, they can often increase your home's resale value. It really is a smart financial move, and it's good for the planet too. A true win-win.
It really is. And the importance of checking the current IRS guidelines for what specifically qualifies and what the credit limits are, well, that cannot be overstated. These programs, they evolve. Tax laws change. For instance, the Inflation Reduction Act of 2022, it significantly expanded and extended several of these residential energy credits, things like the Energy Efficient Home Improvement Credit and the Residential Clean Energy Credit. So the types of heat pumps, the specific efficiency ratings for windows, the kind of solar equipment or battery storage, the R value for insulation, it's all precisely defined by current standards. You need to make sure your specific project qualifies under the rules for the year you do the work. These incentives, they're part of this broader federal strategy, right? To push for faster adoption of green energy tech, reduce the national carbon footprint, improve energy independence. And they represent this tangible way the government basically partners with you, the homeowner, to achieve these national goals. They make these sometimes costly upgrades more affordable, more appealing by directly offsetting a percentage of the installation cost right on your tax return. It effectively makes being environmentally responsible a fiscally attractive decision.
Okay, this next one. This one is a real game changer, especially when it's time to sell your home. Maybe you're moving, upgrading, downsizing. It's the capital gains exclusion on the sale of a primary residence. Here's the headline. When you sell your primary residence, the home you actually live in, you can exclude a very significant chunk of the profit you make from capital gains taxes. How significant? Well, up to $250,000 of profit can be excluded if you're a single filer. And get this. For married couples filing jointly, that amount doubles. Up to an incredible $500,000 of profit can be excluded from taxes. Now, there's a key condition. You have to meet what's often called the use test and the ownership test. Basically, you must have owned the home and lived in it as your primary residence for at least 2 out of the last 5 years leading up to the date of the sale. Those 2 years don't have to be consecutive, by the way, this provision. It allows homeowners to build substantial tax-free wealth through home appreciation over time. That is incredibly powerful for long-term financial planning, for asset accumulation. Just imagine. You buy a home, you live in it for several years, maybe you do some improvements, the market goes up, and when you sell, a huge chunk of that profit, maybe even all of it, comes to you completely tax-free. It's a massive financial advantage that most other investment types, like stocks or bonds, simply don't offer.
It absolutely is a game changer. And this raises an important strategic question, right? How does this exclusion impact your decisions about when to sell? And how fundamentally different is it from selling, say, an investment property? For your primary residence, meeting those tests, the ownership test and the use test, 2 out of the last 5 years, that's the key. And it's incredibly generous. Why? Because think about other investments. If you sell stocks you've held for over a year, you pay capital gains tax on the profit. If you sell a rental property, you pay capital gains tax, potentially depreciation recapture too. But this exclusion on your main home, it's specifically designed to support individual wealth building and mobility. It lets families grow, change jobs, relocate, whatever, without getting hit with a huge tax bill on the appreciation of their primary asset. This lets you leverage your home equity much more effectively for whatever comes next in life. Maybe it's the down payment on a bigger home. Maybe it supplements your retirement income later on. Maybe it helps pay for college. It truly is a unique advantage of homeownership compared to almost any other investment. It provides this tax-efficient pathway for building wealth, maybe even passing it on.
It's such a powerful benefit. Okay, moving on to one that's maybe less commonly known, but still pretty significant, especially when you're first buying the points deduction. You know, when you're going through that closing process for buying a home, it can feel overwhelming, right? All the paperwork, the fees. Well, sometimes you might encounter something called points or discount points. What are these? They're essentially a form of prepaid interest. You might choose to pay them to your lender at closing in exchange for getting a slightly lower interest rate on your mortgage over the life of the loan. So, if you paid points when you purchased your home, good news, you may be able to deduct the cost of those points. This usually provides an upfront saving, typically deductible in the year you actually buy the home, which can be a very welcome bit of tax relief amidst all those other closing costs and moving expenses. It's one of those details that could easily get overlooked if you're not specifically aware that it might offer tax relief.
Right. Let's clarify what points are again. They're basically upfront interest you pay at closing. Each point typically equals 1% of your total loan amount. So on a $400,000 mortgage, if you pay 1 point to maybe shave an eighth or a quarter% off your interest rate, that's a $4,000 cost up front. Now, our sources confirm generally you can deduct those points in full in the year you purchase the home, provided certain conditions are met. What conditions? Well, the loan has to be for your principal residence. The loan proceeds must have been used to actually buy or build your main home. Paying points has to be an established business practice in your area, and the points paid weren't excessive, within the normal range. Also, crucially, the points must have been paid directly by you, not just rolled into the loan principal without you bringing cash to cover them, though points paid by the seller on your behalf might still be deductible by you. This is different from other closing costs like appraisal fees, title insurance, recording fees. Those generally aren't deductible. They get added to your home's cost basis instead.
Now, while getting the full deduction in the year of purchase is common for a straightforward home buy, it's worth noting, in some specific situations, like maybe certain types of refinancing, or if the points aren't directly tied to the actual purchase price, they might need to be amortized. meaning deducted gradually over the entire life of the loan. But for most new home buyers paying points up front, it's a nice direct saving in that first year, helping ease that initial financial load.
Good clarification on the paid by you part. Okay, finally, rounding out our big 7 federal advantages. The home equity loan interest deduction. So if you take out a home equity loan, which is typically a fixed term loan based on your equity, or maybe a home equity line of credit, HELOC, which works more like a credit card backed by your home, the interest you pay on that loan might be deductible. But here's the crucial distinction, and this is super, super important to understand. The funds from that home equity loan, or ELOC, must have been used specifically to buy, build, or substantially improve your qualified home. That means the home securing the loan. This is very different from using a HELOC for other stuff, right? Like if you use it to consolidate credit card debt, pay for college tuition, buy a car, take a big vacation. In those cases, the interest you pay is generally not deductible anymore. That changed with the 2017 tax law too. So if you're using that borrowed equity to invest back into your home, maybe you're adding a new bathroom, doing a major kitchen renovation, building an addition, replacing the roof, making other significant capital improvements that add value or prolong the home's life, then this deduction can help. It effectively lowers the cost of financing those improvements and increasing your home's value. It directly incentivizes you to reinvest in the property itself.
Absolutely. And this brings up a really important question about documentation and the specific requirements, because the deductibility here is strictly tied to the use of the funds. Well, meticulous record keeping is absolutely essential, non-negotiable, really. You must be able to prove, if asked by the IRS, that the loan proceeds were indeed used for those qualified home improvement purposes. What does that mean practically? Keep receipts, keep contracts with your builders or contractors, keep invoices. Any evidence that clearly links the money you drew from the HELOC or loan directly to the eligible home improvements you made, you need that paper trail. The underlying principle here is clear. The tax code wants to encourage responsible use of home equity, specifically for enhancing the property, which benefits you, the homeowner, by increasing your asset's value. And it arguably benefits the broader housing market, too, by encouraging upkeep and improvement of the existing housing stock. It's just another powerful example of how the tax code is designed to incentivize investment back into the property itself. It fosters that cycle of improvement and value creation rather than just, say, using home equity for consumption.
Okay, wow. So we've really unpacked those big 7 federal tax advantages, and these are hugely impactful for homeowners all across the U.S. But now let's take this a step further. Let's see how these federal benefits interact with what happens at the state level. We're going to use Illinois as a detailed case study here. Why? Because this section really demonstrates that the benefits often don't stop at the federal level. Many states layer on their own, sometimes unique incentives, which can further amplify the financial upsides of owning a home. So what does this all mean for you if you happen to live in a specific state like, say, Illinois?
Well, what's truly fascinating here, and Illinois is a great example, is seeing how states respond to their own unique situations. Maybe it's their economic climate, their specific housing market challenges, or certain demographic needs within the state. They often layer additional incentives right on top of the federal ones. And this layering effect, it can significantly change the overall financial picture for homeowners in that state. Illinois provides a particularly robust example, especially when you consider its property tax situation, which we'll get into, and the proactive steps it takes to support its residents. It really highlights why you need to look beyond just the federal benefits to get the full picture of what's available to you locally.
Okay, let's start right there then. The Illinois property tax context and how it connects back to that federal deduction impact we discussed. Illinois, yeah, it's widely known, maybe even notorious, for having some of the highest property taxes in the entire country. This is a common and often pretty significant complaint you'll hear from homeowners all across the state, whether you're in the Chicago suburbs, downstate, wherever. I mean, some counties in Illinois have effective property tax rates. It's the percentage of your home's value you pay annually well above the national average, sometimes easily exceeding 2%. But okay, despite those high state and local taxes, remember what we said earlier. Homeowners in Illinois can still deduct up to $10,000 of their total state and local taxes, which absolutely includes property taxes on their federal income tax return, provided they itemize. So even with that federal $10 SALT to CAT, this still provides substantial savings for many Illinois homeowners. It helps take some of the sting out of that significant local tax burden. It really is a crucial federal relief valve, partially mitigating the impact of those higher state and local tax bills.
That's precisely right. So while an Illinois homeowner might really feel the pinch of those high property taxes when they pay their local bill, the federal SALT deduction, even capped at $10,000, is still a vital tool for reducing their federal taxable income. It means that at least a portion of those high property tax payments effectively lowers their federal income tax bill. Let's make it concrete again. Say an Illinois homeowner pays $15,000 in property taxes annually. They can still deduct $10,000 of that on their federal return, assuming they don't hit the cap with state income tax first, but property taxes are often the bigger chunk in IL. Now, if they're in the 22% federal tax bracket, that $10,000 deduction translates directly into a $2,200 saving on their federal income tax liability. That's real money, so it significantly mitigates or offsets some of those higher state and local costs. It really underscores why you have to look at the full picture, federal and state, to understand your tax situation and maximize savings. And just as a side note, the reasons for Illinois' high property taxes are, well, complex. It often comes down to a heavy reliance on property taxes to fund schools and other local services, combined with a complicated assessment system and the sheer number of local government units in the state.
Right, a complex issue for sure. But here's where Illinois gets interesting beyond just the federal deduction interaction. Illinois actually offers several of its own specific property tax relief programs. These are designed to directly reduce those burdens for residents. This is where it gets really granular and potentially really beneficial if you live there. First up, there's something called the General Homestead Exemption, often just called the GHE. If you own your home and you live in it as your primary residence, you may qualify for this. What it does is reduce the equalized assessed value, or EAV, of your property, the EAV. That's basically the value your property taxes are calculated on, after state and county equalization factors are applied. So, lowering that EAV, it directly translates to a lower tax bill. How much it lowers, it varies by county, but it's a set amount off your EAV, which can mean hundreds of dollars in actual tax savings each year. Pretty much automatic for most homeowners. Okay, but then for older residents, Illinois provides even more targeted support. There's the Senior Citizens Homestead Exemption. This offers an additional EAV reduction on top of the GHE just for homeowners who are 65 or older. More savings. But wait, there's more for seniors. Illinois also has something incredibly valuable called the Senior Freeze Exemption. Now, this one usually has income requirements. But for eligible seniors who meet those income limits, this program actually freezes the EAV of their property at whatever it was in a base year. What does that mean? It effectively prevents their property taxes from increasing due to rising property values in their area. Imagine how valuable that is for seniors on fixed incomes. It provides immense stability and predictability, protecting them from being taxed out of their homes just because the market went up. And finally, Illinois also offers specific exemptions tailored for persons with disabilities and for veterans with service-connected disabilities. These provide further EAV reductions for these specific groups. You usually have to apply for these, especially the senior freeze and disability ones, often using specific state forms. It shows a really comprehensive effort by the state to cater to different homeowner situations and provide targeted relief, going beyond just the general exemption.
That's a critical point. These Illinois-specific exemptions, while fantastic, are generally not automatic, especially the more targeted ones like the senior freeze or the disability exemptions. Homeowners typically need to apply for them, usually through their local county assessor's office. And often they need to reapply periodically, maybe annually for the freeze, to prove they still meet the eligibility requirements. So understanding the specific criteria for each, whether it's age for the senior exemption, income thresholds for the senior freeze, disability status documentation, or veteran service connection ratings, it's absolutely paramount to actually unlock these significant savings. That senior freeze exemption, for example, it's incredibly powerful protection against rising values, but those income limits are strict and need to be verified each year. These programs really reflect a deliberate policy choice by Illinois. They're supporting specific demographics, recognizing the financial pressures of homeownership, especially for those on fixed incomes or facing unique challenges. It's a direct mechanism the state uses to make homeownership more affordable and sustainable for certain populations, really going above and beyond what the standard federal tax laws provide.
Really good to know you have to be proactive about those. Okay, building on the energy efficiency theme we hit earlier at the federal level, Illinois actually doubles down on green initiatives too. They have their own energy efficiency incentives. So homeowners in Illinois, you can potentially benefit from both the federal tax credits, remember those, for solar efficient windows, HVAC upgrades, and specific Illinois state-level incentives for often the very same energy efficient upgrades. Our sources specifically highlighted programs like the Illinois Adjustable Block Program, often called Illinois Shines. This provides significant state-level rebates paid out over time based on production, specifically for installing solar panels. This is a fantastic example of what we call stacking benefits. You're not just getting that federal tax credit on the installation cost.
Mhm.
You might also be eligible for substantial state rebates or incentives for the same green improvement. What does that do? It dramatically lowers your actual out-of-pocket cost for making these big upgrades, and it significantly increases your return on investment for choosing these eco-friendly options. It's just a huge win for your wallet, for your home's value, and of course for the environment.
Absolutely. And if you connect this back to the bigger picture again, these combined incentives, federal credits plus state rebates, like Illinois shines, they really work together to accelerate the adoption of renewable energy. It helps contribute to energy independence, both for individual households and for the state overall. This stacking effect makes technologies like rooftop solar much more financially viable, much more accessible for the average homeowner than they would be otherwise. Think about it. A homeowner installs solar panels. They might get that 30% federal tax credit right off the top of the total cost. Then, they might also qualify for the adjustable block program incentives, which effectively pay them back over time for the clean energy their system generates. This often makes the payback period for these solar installations considerably shorter, sometimes dramatically so. It really turns the decision to go green from being just an environmental choice into a very, very shrewd financial one. It shows how effective policy can be when federal and state levels align to drive both economic benefits for individuals and achieve those broader societal and environmental goals.
Okay, and just to hammer this home one more time for Illinois residents, that huge capital gains tax exclusion we talked about earlier, it absolutely applies in Illinois too. When you sell your primary residence in Illinois, you can still exclude up to $250,000 in profit if you're single, or up to $500,000 if you're married filing jointly from your federal capital gains taxes. As long as, remember, you've owned and lived in the home as your primary residence for at least 2 of the last 5 years before the sale, this is a universal federal benefit. It applies regardless of which state you live in, and it remains this incredibly substantial tax-free profit opportunity for Illinois residents when they eventually sell, whether they're upgrading, downsizing, or even relocating out of state. It's just a critical piece of your financial planning when you think about selling your home in Illinois, allowing you to keep more of the wealth your home has hopefully accumulated over the years.
That really is a key takeaway. Doesn't matter if you're in Illinois, California, Texas, Florida. The federal capital gains exclusion is a foundational benefit for homeowners across the U.S., assuming you meet those ownership and use tests. It just underscores again that almost unparalleled ability of owning your primary home to generate substantial tax-free wealth. That really distinguishes it from so many other types of investments. That fact alone makes such a compelling case for viewing your home not just as a place to live, but as a long-term investment asset. It's a significant advantage that can materially, really significantly impact your financial position when you sell. It lets you take that tax-free profit and reinvest it maybe into your next home. Maybe you diversify into other things. Maybe you fund retirement without that immediate drag of paying taxes on all the appreciation.
All right, wow. We have covered a tremendous amount of ground today. We went from those broad federal advantages that apply to pretty much every homeowner in the nation, all the way down to the specific nuances and those extra incentives you might find in a state like Illinois. So, after all that, what does this all mean for you? What are your next steps? It seems pretty clear that navigating all these tax advantages, while incredibly beneficial, can also be, well, complex. And that leads us directly to what might be the most critical, truly indispensable piece of practical advice we can offer. The first step, maybe the most important practical step you can take. Recognize the absolutely indispensable role of a qualified tax professional. Tax laws are complex, they change, and how they apply vary significantly based on your unique individual circumstances, your income, your filing status, your state, the specifics of your home purchase or improvements. We simply cannot overstate how critically important it is to consult with a qualified professional. We're talking a certified public accountant, a CPA, or maybe an enrolled agent, an EA, someone who specializes in taxes. Why? To truly maximize your deductions and credits. They have the expertise to navigate all the nuances of your specific financial situation. They make sure you don't miss out on valuable savings you might not even know about. And just as importantly, they help you avoid costly errors, mistakes that could potentially trigger an audit or lead to penalties down the road. Think about it knowing the subtle difference between, say, a repair, which usually isn't deductible for home equity interest, versus a capital improvement, which might be, or understanding the precise documentation needed to substantiate a home office deduction. That kind of expertise can make all the difference. So while we've aimed to give you a really comprehensive overview today, we strongly urge caution against trying to self-navigate all these intricate details without getting expert guidance tailored to you. Your tax situation is unique. Getting personalized professional advice is absolutely key, both for compliance and for maximizing your financial benefit.
And this naturally raises that important question people ask. Is paying for professional tax advice really worth the cost? Well, in almost all cases, yes. The savings a qualified professional can find for you, maybe through deductions and credits you'd completely miss on your own, or just by correctly applying complex rules to your specific situation, those savings often far outweigh their fees. Plus, think about the peace of mind they provide. Knowing your tax return is accurate, it's optimized for your benefit, and it's defensible if the IRS ever asks questions. That's immensely valuable. For instance, a good tax pro might uncover some lesser-known local property tax abatement program you qualify for, or maybe a specific federal credit for a type of energy improvement you made that you would have otherwise completely overlooked. That could mean hundreds, maybe even thousands of dollars back in your pocket. And it's also vital we reiterate this point, just as our sources emphasize. All the information we've provided in this deep dive, it's purely for informational and educational purposes. It is absolutely not tax advice, and you shouldn't treat it as such. For personalized guidance that's tailored to your unique financial situation, your specific numbers, your life events, you always need to consult a qualified tax professional. Their expertise in navigating this complex landscape is truly invaluable.
Absolutely critical advice. Now, beyond just the tax advice, maybe you're feeling inspired by all this. Maybe you're thinking more seriously about taking that step towards homeownership, or perhaps you just want to explore the possibilities more concretely. Well, remember, reaching out to experts is also key for navigating the mortgage process itself. That's a whole other complex area. Our sources today actually came from a guide that strongly encouraged contacting mortgage companies directly. Why? To explore how homeownership can benefit you financially, help you understand the costs, and start that process of building equity. So, for example, you might look into resources like Emmett Clark with loansbyemmett.com. Professionals like Emmett and his team, they live and breathe this stuff. They can help you understand the whole lending process, explore the different types of mortgage products available, figure out what you might qualify for, and crucially, they can help you connect the dots, help you see how these very tax advantages we spent this whole deep dive discussing might actually apply to your specific mortgage situation and your overall financial goals. They can often provide a much clearer picture of your true after-tax monthly housing cost, factoring in potential deductions. It's really about empowering yourself first with comprehensive knowledge, like hopefully we've provided today, and then leveraging that knowledge by connecting with the right professionals, tax pros, mortgage pros, who can guide you through those practical next steps. Ultimately, though, perhaps the biggest takeaway from all of this is just the sheer empowerment that comes from knowledge itself. Look, it's easy to feel overwhelmed by the sheer volume of information out there, especially when it comes to big topics like homeownership and taxes. They intersect in complex ways. But our real aim with this deep dive today was to cut through some of that noise, provide you with clarity, and hopefully some confidence too. Because understanding these advantages, it really does transform how you might view homeownership. It shifts it from being merely a large expense or just a place to hang your hat into recognizing it as a truly strategic, potentially powerful, long-term financial investment. It's about seeing that full picture, recognizing those aha moments. We talked about the mortgage interest deduction, the capital gains exclusion, the state-specific benefits that unlock real savings and offer powerful wealth-building opportunities. Your home isn't just a dwelling. It's this dynamic asset with significant tax implications that can genuinely help shape your financial future for the better. So just to quickly summarize what we've really delves into today, we explored that whole breadth of federal tax advantages, the big mortgage interest and property tax, SALT cap deductions, the increasingly vital home office deduction, those valuable energy efficient tax credits, that absolute game changer, the capital gains exclusion, the often overlooked points deduction, and the strategic home equity loan interest deduction for improvements. And then we drilled down, using Illinois as an example, to see how states add their own significant layers, specific property tax relief programs like Homestead and senior exemptions, plus additional state-level energy incentives, showing how these benefits can truly stack up. The bottom line, homeownership really does come with some valuable, often seriously underestimated financial upsides that are built right into our tax code, both federally and often at the state level too. So, as you reflect on everything we've unpacked in this deep dive, here's a final thought to mull over. Consider how understanding these comprehensive tax benefits might fundamentally shift your perspective on homeownership. Could it transform it in your mind from just being, a place to live, maybe a forced savings account, into seeing it as a foundational cornerstone of your long-term financial strategy, a key part of your wealth accumulation plan? How might this newfound knowledge influence your future investment decisions? Perhaps encouraging you to view your home not merely as an ongoing expense, but as this powerfully tax-advantaged asset within your overall financial portfolio. Really internalizing that awareness, it could profoundly alter how you approach building wealth for decades to come.
What a journey through the tax code. Thank you so much for joining us on this deep dive into the tax advantages of homeownership. We really hope you found it insightful. We definitely encourage you to keep exploring, maybe talk to those professionals we mentioned, and apply this new knowledge to your own situation. Until next time, keep digging deeper.